If you paid attention to the media recently, you would have seen sensational claims about the imminent fiscal demise of the country. It's almost certainly wrong that in a 2-year horizon, we could experience trouble either funding the existing debt stock of government or financing the financing needs of government on that horizon. But I'm still a concerned citizen about fiscal policy, and I'll tell you why. So in the developed world, we've had, in some countries, a more than 100% rise in public debt. On average, it's a little bit less than that. But you know the sensational examples in Europe and elsewhere in the developed world. These countries bailed out the banking sector. Those countries that did not bail out banking sectors, this is the emerging market graph. If you didn't have to bail out the banking sector, there was no reason to expect this jump in public debt. But where are we on this graph? There's the South African version of the picture. And you'll see that the level of debt is dramatically lower than in the developed world. But it has been rising sharply in recent years. So why did we have this trajectory of rising debt? We didn't have a banking crisis in South Africa, so that the obvious explanation is not correct for the South African case. The reasons I list for you are up on the slide. Not a full list because, of course, the budget has very many line items and increases occur right across the board. But some of the big ticket items I've listed for you there. About a third of the increase is due to an increase in the public sector wage bill. Another 15% due to increased government consumption expenditure, and about an 11% due to a rise in transfer payments. So that accounts for a little more than half of the total increase in the size of government relative to the rest of the economy that we've seen since the start of the financial crisis. But these things are not crisis related. They have become structural. They are the way we have decided. This is a fiscal policy decision. It is a priority decision. This is the decision we've taken on the size and shape of the state that we want after 2008. That's why we've seen the red line rise. And what has happened is the red line now sits structurally higher than the black line, which is the revenue line, and that's where our deficits come from. And the deficits need to be financed, and so rises the debt stock. To get a grip on the risks posed by debt stock, it's useful to scale the debt stock by the tax base in the economy. And the tax base in an economy with a developed tax structure like our own is a function of the total income in the economy, the level of GDP. We have corporate tax, VAT, and personal income tax. This is the bulk of our tax income. And so it's useful to, if you want to think about the risks of government debt, to scale the total debt stock by GDP. And so we talk about the debt to GDP ratio. This is what has happened to GDP growth in the economy, or a proxy for the growth rate of our tax base. And the black line is the one that should really worry you. So the black line is an assessment currently of where the economy's potential growth rate is. It doesn't tell you where the growth rate is now. It is where current model-based econometric assessments tell us is the potential growth rate for our economy. This is the real concern, because this is the number which tells you, if you want to project into the future the potential tax base for the economy, where our growth is likely to be anchored. We want that number to be 5 or 6. It is sitting at 2. And this is what has happened to the real interest rate. This has been a benefit for us. The fact that the real interest rate has come down such a long way, and this is also a policy result, so it's partly responsible fiscal policy, and it is partly responsible monetary policy. And the third part is that it is the result of massive asset market interventions by policymakers internationally, which has pushed liquidity into asset markets. And that last factor is now reversing. Very few countries find it possible to spend 6% of GDP on interest and be able to satisfy all the many other requirements or priorities on the public sector. Now, we're a very long way from 6%. But we're a long way from 6% partly because interest rates have remained very low, and partly because the debt stock is still at what is, on an international comparison, a comparatively low level. And now that brings me then to trying to model what is likely to happen to our debt stock over time. And so this is a bit of econometric work. What we do is we simulate the economy many times over, 100 times over, and what I present you on the slide is the median in red of all the potential simulations for the economy with different random shocks. The upper dotted line is the 75th percentile, the bottom dotted line is the 25th percentile, so a half of the simulations lie between the two dotted lines. But when I made this presentation that we were likely to experience a rise towards the sort of mid-40s% in the median, this caused a lot of concern in the fiscal workshop, and they said it must necessarily be wrong. In fact, the referee of my academic paper said, I have surely confused the business cycle with structural decisions in the economy. So the reason I tell you that, right, so macroeconomists are rarely right empirically. So, so this is one I'm going to show you now. This is the medium-term budget expenditure framework for the next period, right? So but it's still the expectation that the debt stock would flatten off, and then for the next year, and then for the next year. And now I've redone the model. So of course, the actual debt stock has run out over here, right? That's why the medium-term budget expenditure framework is always going up. That's where we are now, always expecting the debt stock to taper off. This is the simulation with the latest data. That's still the median over here, and the bands. And I now have to give you a higher scale. So that's where we now end up with over the sort of medium-term framework, up towards the sort of higher 50s, even 60% of GDP. Given the current structure of interest rates in the economy, we will certainly be able to carry that debt burden. So that's not the concern. But the concern is that the interest rate structure does not remain invariant to this rise in the debt stock. It's a long way off, right? There are 10 years between where we are and that point there. It's extremely hard to turn around fundamental fiscal problems once you're in the crisis and in the short run. So both of those things are difficult. Short-run changes are difficult, and it's even more difficult once you're in the crisis. You have to preempt, and you have to do this over a long horizon. So we can talk about changes in taxation, or we can hope to get the real interest rate down. And then the other possibility is economic growth, right? Because we can carry much more debt if the economy becomes vibrant and the tax base grows rapidly. We have already a very developed fiscal tax structure in the economy. But we are now collecting tax which in our part of the world, in the emerging market part of the world, is already a high proportion of GDP. By the way, Japan is down here. And then economic growth, because that seems like the easiest answer. If only we can get economic growth up, and it is an easy answer, except it's not a policy. Economic growth is an outcome. If it was a policy, there would be no poor countries in the world. We want to avoid overtaxation. And I really do think one of the issues we ought to talk about are the obstacles and the inefficiencies from the logistical sector, a big part of which is dominated by state-owned enterprises. If you have an inefficient company that's extremely large, that is being continuously supported by the taxpayer, it also ruins the market from the private sector's perspective in the same sphere. We need to also look at the portfolio of activities in which government is currently involved and ask where are there comparatively easy productive gains to be made from the economy. That will also save us money. Because to the extent that we are saving money on these kind of activities, the red line comes down. We have a number of policy frameworks out there, and that's why it's so good to have discussions like this today. Because at least from a private sector perspective, there seems to be gaps in the coherence between, for example, the National Development Plan and the New Growth Path and the perspectives in IPAP. But I'm sure from a cabinet perspective, it looks very different. We do a survey every quarter of why manufacturing firms are either investing or not investing. And we ask them, if you're not investing, why are you not investing? It's a busy chart. I just want you to pay attention to the red line. The red line tells you the proportion of firms who say they are not investing and who give the reason that there are political constraints to them investing. And it is at a level, this uncertainty in terms of politics, that we haven't seen since all the way back, if I put the chart back, to the second quarter of 1994. Because we are not seeing the investment. Businesses are telling us why they are not investing, and we are seeing it if we look at the national accounts data, that whilst government has pushed up capital investment in the economy, the private sector has had an investment freeze in this upswing, which is why Andre told us at the start that this has been, though a long upswing, one of the most anemic. I tell my class that since 1970, this is the least inspiring economic upswing we've had, and it's a very poor class to be the worst kid in. If, on the other hand, we had a 5% potential growth rate in the economy, and I changed nothing else in my analysis, just that one parameter. If we solved the constraints on growth in the economy, then the fiscal problem solves itself. We wouldn't even have to take any of the hard fiscal decisions because then that would happen. So if you put a line out there, that's where the minister wanted to cap the debt stock. And so that can happen, but it can only happen through extremely tough fiscal decisions about the size and shape of the economy. No easy tax decisions as far as I can see, or a real grip on the potential growth rate for the economy.